แกเสียชีวิต
ในแห้งนี่นะแกนั่งอยู่หน้านี่แกนั่งอยู่หน้าบ้านเนี่ยแกจะไปไม่ไปจะไปไม่ไป
ทำไมอ่ะ
ก็มีความกังวลเหมือนว่าอีกใจก็แกก็เหนื่อยแกไม่สบายอีกใจก็ไปเจอที่ไปแล้วอย่างที่ผมบอกกับแกจุดประสงค์จะไปเอากระโดง
เอากระโดงเรือ
ใช่แกจะไปเอากระโดงเรือขึ้นตอนนี้จะไปไม่ไปจังหวะว่าอย่างน้องชายผมเนี่ยบอยเนี่ยเขาจะทำคู่กันตลอดพอมาพักหลังเขาจะไปกับบอยตลอดบอยเขาไปรออยู่หน้าวัดแล้วก็โอเคเขาไปประมาณสักบ่ายกว่าเนาะแม่แห้งเขาเลยออกไปก็ไปดำกันประมาณสัก4 โมงไงบอยมาตะโกนแม่แห้งจมน้ำให้จมน้ำผมนั่งอยู่ในบ้านพอดีผมว่าถามสาวเราเรื่องว่าให้บอยมันยังไงกันวะบอกพี่นายแห้งเขาดำเขาลงไปหายประมาณ2 ชั่วโมงลงมาตรงนั้นเรา2 ชั่วโมงแล้วยังไงต่อผมก็กระตุกครั้งหนึ่งแล้วแกก็ไม่ขึ้นปล่อยอีกประมาณ1 ชั่วโมงกว่า
ปกตินี่เวลากระตุกต้องกระตุกต่อไหมเหรอ
ก็ผมก็ยังหาตัวเองไม่เจอว่าถ้าเกิดว่าคนในน้ำไม่ขึ้นอ่ะมันมี2 อย่างเขาอาจจะเจอของอย่างที่ผมบอกอาจจะเจอของยังไม่ขึ้นแต่ที่ความที่บอยก็กระตุกไปเนี่ยเห็นว่าน้าแห้งหาแบบว่าน้าแห้งไม่กระตุกกลับแสดงแกคงเจอที่เหลือบอยก็ปล่อยให้ดำต่อแต่ที่นี่คือวันนั้นบอยมันก็ตกใจว่ากระตุกไปแล้วเนี่ยแห้งแกนิ่งพอนิ่งเสร็จปุ๊บบอยมันก็ค่อยๆสาวสายลมขึ้นมาสาวสายลมเนี่ยทีนี้มันหลุดไปจากหัวเลยบอยมันก็สาวขึ้นมาจะมารู้แล้วว่าน้าแห้งจมตายแล้วพอตอน6 โมงครึ่งวันนั้นผมลงไปแล้วผมก็สงสารนะเรามาเป็นอย่างนี้ก็ลงไปงมศพนะก็ลงไปกับน้อง2 คนน้องก๊อฟนะประดาน้ำเหมือนกันเขาเป็นกู้ภัยด้วยพอลงไปเสร็จพอลงถึงโคตรสมอปุ๊บผมก็ตามกะว่ายังไงก็ต้องเจอสังกระจายคาคล้องมือในแห้งไว้ยังไงเจอก็ต้องเอาน้าขึ้นเดี๋ยวนั้นเลยพอผมสาวสังกระจายปุ๊บดันไปเจอกับกระโดงเรือครับและแห้งแกเชือกสังกระจายไปพันกับกระโดงเรือผมก็ตัวแกไปไหนไปพันกับกระโดงเรือผมก็เอามือพยายามจับหาปลายเชือกไม่มี
อันนี้ไม่เห็นด้วย
ไม่เห็นแต่ผมรู้ไงไปเจอศพในแห้งถัดลงจากที่ผมเจอกระโดงเรือเนี่ยประมาณแค่วาเดียววาฝ่าร่วม2 วาเท่านั้นเองเพราะว่าตรงนั้นมันเป็นเหวว่าใครมันเหวลึกลงไปเลยมันเป็นซากเรือเก่าเรือสำเภาเก่าแต่ปลายกระโดงที่แกไปผูกนะปลายเป็นโผล่นะแต่ท้ายเนี่ยเป็นโผล่ไหนยังไม่รู้
สมัยอยุธยาเนี่ยนะคะเป็นพ่อค้าหรือว่าเป็นนักเดินทางที่จะเข้ามาติดต่อค้าขายกับในสมัยอยุธยาเนี่ยเยอะมากเลยค่ะอย่างเช่นจีนนะคะญี่ปุ่นก็มานะคะเกาหลีแรกเลยนะคะแล้วก็ยังจะมีพวกยุโรปในตอนช่วงอยุธยาตอนกลางแล้วก็จะเห็นยุโรปแต่จริงๆที่เป็นยุโรปเหมือนกันเนี่ยก็เข้ามาตั้งแต่สมัยพระรามาธิบดีที่2แล้วช่วงอยุธยาตอนกลางคุณก็จะเห็นมีฝรั่งเศสนะคะที่เข้ามามีอังกฤษนะคะแล้วก็ยังมีเรือจากพวกที่เป็นกลุ่มเกาะที่อยู่ข้างล่างด้วยกันเองก็ขึ้นมาค้าขายที่อยุธยาเช่นเดียวกัน
From New York City for our viewers worldwide, I'm Lisa Abram. In for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, Inversion Watch, the U.S. yield curve recording its longest stretch of flattening since November of 2015. Investors don't care, with wagers on a steepening yield curve gathering momentum on Wall Street. And the momentum in high grade continuing to build, with buyers flocking to new debt sales and bonds rallying in the secondary market. We begin with the big issue. Markets debating whether a flatter yield curve is here to stay.
You've seen the flattening of the yield curve.
The yield curve is incrementally flatter.
We expect that to continue for the short term.
It has been catching a lot of investors off guard.
We're still playing the flattener.
The steepening of the yield curve, which I think is there for the long haul.
At this point in the overall Fed cycle, we would anticipate that the curve should steepen out somewhat.
And you're going to start seeing more late market cycle behavior, and part of that late market cycle behavior is a flatter yield curve.
If the Fed is on hold, does let the economy run hot, that'll keep the short end suppressed, which everyone expects, but you might start to see the long end drift higher.
You have a market that's essentially, from a rates perspective, priced for recession, but from a spread perspective, is telling you there are no risks whatsoever. And that is not really a tenable situation.
The launchpad controls are very much in the hands of politicians right now, as opposed to central banks.
If you start seeing some of these deals go through, you could see a steepener.
If it happens, actually, we think you create the conditions for an upside to expectations on inflation, and we think that gets manifested in the yield curve steepening.
Joining us from London, Ian Steely of JP Morgan Asset Management, as well as James Affey of Aberdeen Standard Investments. And joining me here on set in New York is another Ian Lingen of BMO Capital Markets, really talking about the yield curve. We've seen a shift with a growing number of strategists saying they do expect the yield curve to steepen next year. James, let's start with you. What's your take on that?
Hey, afternoon, Lisa. Good to see you again. Yeah, I mean, essentially, we've been running the steepener all year. Essentially, the
combination that we like is to be long duration and running steepening risk. We, prefer to take the duration risk in the front end of the yield curve. Because, and certainly now, essentially what the Fed has done is raise the bar to hiking rates, ridiculously high. That's not going to happen anytime soon. It means that the yield curve is pretty direct. Here, but when you've got US 2 years already trading above the effective Fed funds rate, historically that tells you the market expecting hikes, which is obviously not, as I say, likely to happen anytime soon. So there's a massive asymmetry towards being positioned in the front end. And therefore the combination of being long and in steepness, I think just, that can profit in a number of different scenarios. One of your guests in the clips that you were saying there was sort of concerned about potential inflation risk and steepening the yield curve that way. To say, even though I'm running the steepener, I find that quite difficult to believe when you just look at the oil price and you look at the base effects. Notwithstanding the end of December, which is going to see an upside from base effects, it really does seem like, unless we have a massive oil rally, headline inflation is really going to struggle to make any headway higher over the next 6 to 12 months. So for that reason, we're not it's an inflationary bear steepening of the curve, but we've seen recently with bond markets, it doesn't take much of a push upwards to see that curve getting dragged steeper in a bearish environment.
All right, so a pretty nuanced take, Ian Steely here. We're looking at potentially a steeper yield curve, but don't get too excited that this actually means that inflation is going to pick up. Is that what your take is?
I think the reality is, it's basically, as James said, what you've got now is you've got a 2-year part of the curve that's effectively anchored to some extent by the Fed on hold. Although, a little bit of cuts priced in over the next year or so. But for all intents and purposes, the Fed's told us they're going to be on hold, which means actually the curve is going to be bounced around and buffeted around by what happens to the 10-year. And at the moment, it just feels like we're so reliant on what the outcome of trade is over the next few weeks as to the directionality of the 10-year. If we're in an environment where you do get tariffs added in mid-December, the reality is I think you're going to probably see the lows in yield for the year on the 10-year, and that's going to be a curve flattening. The flip side of that is if we get some form of rollback, good news on trade, then I think you're going to see yields push up back towards 2 and maybe through, and that's going to be a steepening because the 2-year part of the curve is unlikely to move much from here until we see the Fed talk about actually either moving monetary policy in either direction.
Ian Lyngen, I can just feel the exhaustion in Ian Steely's voice. Do we have to talk about this again? Why do we care? I mean, honestly, if we're not going to see a pickup of inflation, if this isn't going to say something about Fed policy, if this isn't necessarily going to signal a recession, recession. Do we care about the yield curve?
Well, I think it's fascinating. The market tends to spend a great deal of time focused on the shape of the yield curve and what it means for the next 2 or 3 months worth of trading. But if we look at the relationship between the 3-month bill and the 10-year yield, there's about a 1.5 year lag when that curve inverts and when we actually start to see a pickup in recessionary risks, because it takes that long for that spread compression to work its way through to corporate profitability. Then that hits the employment sector, the consumer starts to lose momentum, and that's where any recession in the U.S. is really going to come from. So there's a delayed effect, and it really becomes a 2020 story that I think that we need to focus on.
Okay, because we did see that inversion for a sustained period between the 3-month and the 10-year yields. That said, I do want to talk about this exhaustion that sort of seems to be pervading the markets. And it's not because it's the day after the Thanksgiving holiday in the U.S., although perhaps that's part of it, the tryptophan from turkey. But I'm wondering, James, from your perspective, do you think that bond markets have generally entered this sleepy phase where central banks globally are just tamping down any volatility, and that's what we're going to get for the next few months?
I mean, entered that phase, Lisa. We've been in that phase for about 12 years or so.
Well, except for there was 2013. There was a blip there. There have been a couple of experiences with some excitement.
Exactly, sure. 2018 was very much different to what we've got used to experiencing. We've had those couple of mini cycles where 2012, 13, 2015, 16 we saw dramatic changes in these market reactions, but beyond that, essentially what we've got used to is, central banks in general and the Federal Reserve specifically just pumping painkillers into financial markets on just an almost constant basis, and you get this barbell of buy risk and buy safety, risk parity type approach, which works almost in all environments, almost regardless of what's going on under the hood. And it very much feels like we've re-entered that phase with recent policies from the Federal Reserve, which they may call something other than QE, but by anybody else's definition, including Ben Bernanke's in 2009, this absolutely is QE, and it does appear to be starting to have that impact whereby equities can ignore a lot of noise and bad news and just drift higher, but they can only do that in concert with bond yields falling. So it does feel a bit like that environment, but I do expect that to change in 2020.
Ian Steely, we're going back to the drug addiction metaphors here with the market and central banks, and I'm wondering what that implies for 2020. In other words, have we brought forward that trade of go into risk, barbell that approach, go into the safe government bonds as well as risky assets and call it a day? Are we going to see the same thing in 2020, or is something going to shake this complacency?
It does feel, you're right, it feels a little bit like that. And I think if we go back and remember, you mentioned earlier 2018, that was a tough time. We obviously had quantitative tightening and we had hikes from the Federal Reserve, and we've got the exact opposite now. I completely agree with James. They might not want to call it QE, but ultimately they're injecting liquidity into the system. It's going to go and it's going to actually end
and providing even more cheap or free liquidity. Yeah. My concern would be when we start to see the economy slide further towards that sort of scary looking zero number. It's always the weakest links in the chain which are going to fall first, and I would observe globally, and not just in investment grade credit, but across a number of asset classes in a number of economies in a number of regions, we've already begun to see the weakest links in the chain starting to crack. Ian also mentioned auto delinquencies. That's something that we've seen for taking on the risks in a segment which is bigger than the entire high yield market in aggregate.
So you're not buying triple Bs right now?
Absolutely not.
Oh, this is a really interesting conundrum, and James, you raised an issue. Interesting that a growing number of investors and makers are highlighting, which is what are the unintended consequences of yet another wave of stimulus this late in the credit cycle. Europe's largest asset manager, Amundi, warning investors of a potential blow-up in credit, writing, quote,